Hey, everybody. Welcome back to the Financial Freedom Show. My name is Rob Berger. It's good to be back. It's been just over 3 weeks since the last show. I'm trying to think, has anything interesting happened in the world? I don't know. Maybe. I performed fairly poorly in the chess tournament over the 4th of July. That definitely happened. I hope everyone is doing well. If you can see and hear me, give me a thumbs up, please. Oh, I already got it. Thanks, Frank. Didn't get a thumbs up, but I got a video good, audio good. So that's great. So I want to cover a couple of things to start with, and then I'll get to the important stuff, which is your questions. I see more thumbs up. Thank you. And I do want to do a poll that I'll start now while I cover some introductory things, and then we'll get to your questions. And it is, should I do more interviews? Do you guys like that? And so the poll will just be yes or no. I guess I'll add, I don't care. I mean, maybe you don't care. If you like the idea of more interviews, in the chat, can you put in either specific individuals you'd like to see on the show and/or just topics covered? I kind of want to do it, I think, because it's just fun. There's that. All right. So I want to cover a couple of things. First of all, so today's Tuesday. Hopefully, if you get my newsletter that goes out every Sunday morning, you know that I had to switch from yesterday to today. If you don't get the newsletter, it's free. It goes out every Sunday morning. I don't bombard you with emails. I had one person ask me if I sell the email list. I don't. I wouldn't know how. Oh, I mean, I suppose I could Google it and figure it out, but no, I don't. And I have a link in every email. You can unsubscribe. I hate it when I get an email and there's no unsubscribe link. So I put in there updates if things change. So Lord willing and the creek don't rise. There'll be another live show 2 weeks from yesterday. And I think what I'm going to do that week as well is do a new retirement working session. Those that have been with me for a while may recall I did one, I don't even know when, a year ago, I don't remember. But it's a live stream like this, but it's all focused on new retirement and retirement planning issues. Because the benefit of using any, I think, decent retirement planning software, whether you use New Retirement or something else, is that it forces you to think about some stuff and answer some questions. Some of them are not that easy to answer. It's not just about the software. It's about, all right, when should I take Social Security, or my spouse take Social Security? And do I need to worry about IRMAA? And what should my expected rate of return be? And, on and on and on. In that regard, very quickly, I'll just show you this. We can look at it more in 2 weeks. This is a demo version of New Retirement. Two big developments with this software. The first is you can now look at the dollars. They have a lot of graphs like this throughout the software in different ways, showing you income, expenses, and so on. And in the past, it always showed you this in future dollars. And a lot of folks wanted to be able to look at this in today's dollars. So you can, of course, you can set the inflation assumptions in this software, but then you can also right here pick today's dollars. And so that, of course, would lower this number. Let's see, projected savings, 3.7 million. Future dollars, it's 8.9. I don't remember what I have the inflation set on in this demo, but that's the first big change. The other big thing they did is they've got this beta section, it's in beta testing, financial wellness, where it sort of looks at your plan and tells you, what's going well, what's vulnerable in this plan. Estate planning documents. Yeah, I didn't really fill that out for this demo account. Earliest possible retirement date. The planner estimates you could probably retire in December 2026. Oh, interesting. So I could dive into that. But that's a new feature. So I thought I'd share that with you, but I'm not going to go into any more details on that. We can look at it in 2 weeks in the working session. By the way, I'll probably do it in the evening, like the live show. It does get recorded, though. So if you can't make it, you can always replay it later. All right. So my topic for tonight, it'll be very brief. And it came up because, obviously a lot's happened since we were last together. Obviously, the assassination attempt, President Biden has dropped out of the race, as you all know, and presumably Kamala Harris, the current VP, will be the Democratic nominee. I guess that's not confirmed, so anything could happen, but it looks like that's what's going to happen. And I've noticed in sort of general financial media, and this occurred even before all of these events over the last couple of weeks, you had all this speculation about the stock market and the economy if Biden wins, or now perhaps Harris wins, or if Trump wins. There's articles on the Trump trade, they called it. And that one was saying, hey, if Trump wins, inflation's going to go up. And the reason given, twofold, he was going to impose some tariffs on some imports, which would, of course, raise the cost of those imports. And also, he's a proponent of lowering taxes, which would require more borrowing. Investors would demand higher yields, higher interest. So all these things would happen. Of course, additional spending could obviously increase inflation. So that was sort of the working theory. I don't know if they've got anything similar to that yet for Vice President Harris, but if they don't, they will. And I just wanted to say a couple of things about this. The first is, I am not changing a thing about the way I invest. I don't care who's running for president. I don't care who, well, I care who wins, but not in terms of my portfolio. I'm not changing a thing. I think these predictions about what will happen to the economy if one wins or the other wins, and I get it, they try to evaluate their policies and blah, blah, blah. But I think it's just not something that can be predicted for a gazillion reasons. But maybe the most important is that whatever Trump's stated policies are, or let's assume Vice President Harris's stated policies are, none of it really matters much unless the Republicans, if Trump wins, also control the House and the Senate. Or if Vice President Harris wins, the Democrats control the House and the Senate. Because as we know, if there's a split government, not much is going to get done, at least nothing big, unless it's truly, life depends on it. Like, for example, when COVID hit and there were big legislation that got passed on a bipartisan basis. Now, we're too far away, I think, to even begin to predict who's going to win the House and the Senate, particularly the Senate, but maybe both. I don't know. But I think it's, it can happen, of course. I personally prefer a government that's not controlled by one party. And that's true whether it's Republicans or the Democrats, because I think we get extreme legislation, and and it doesn't really reflect, I think, the will of the people on the whole. So I that's always my vote, some form of split government. I'm okay with that. And it means a lot of fighting, blah, blah, blah. But that's just the way, the sausage is made in Washington. That's just, it's nothing new, by the way. If, I'm getting back to my presidential biographies. I'm going to be starting President Tyler's biography. I got a couple of emails from folks saying that he has a grandson that's apparently still alive. He's got to be what, 110? I don't know. I mean, I don't know when. I'm trying to think. So he was president after Harrison. So this was like Harrison was only president for what, 30 days? This is 1841, no, 41, I think. I don't know how it's possible. I haven't figured all that out yet, but that's what I'm told. In any event, I think it's unlikely that we'll see one party completely dominate. You never know. And even if they do, and a lot of their policies are implemented, we have no idea how that's going to affect the economy, because a gazillion different things affect it, and the stock market. So I just thought I'd share that. I mean, I know that politics, very charged issue. Some people feel very strongly about one side or the other. I wouldn't put myself in that category. I have opinions, but, I've never been to a rally. I know some people that were at the Trump rally where he was during the assassination attempt. Pretty scary, to say the least. One thing I didn't know that I learned was that the people that I knew there are all safe. But when they got to their car, they had to sit there for like 2.5, 3 hours. They weren't allowed to leave for quite a long time. I guess that makes sense. I don't know. What do I know about these things? But I'm not. I think I mentioned this past. Never been to an inauguration, even though I've lived here in the DC area for 32 years. It's just not my thing. Anyway, that's my take on that issue. Feel free to, in a constructive way, share yours in the chat. I suppose some might say, oh no, Rob, you've got it all wrong. If this person wins, this is what's going to happen. And if that person wins, I don't know. I'm not so sure about all that. All right. I got through all that in 10 minutes. That's not bad. Now I can get to the good stuff, your questions. There were a couple that came in before the show actually started. Let me see if I can share them. That was at 7:59. There's a few that came in early. I see so far the yeses on interviews are at 67%. So I can't show the first couple on screen yet. But by the way, I'm going back to taking questions in the chat rather than that form, which generally people seem to like. All right. Here's the question. I have a taxable account. This person, Oblong, has a taxable account, 4 million, Roth account, 2 million, no traditional, all equities. They want to move some to bonds, but they're worried about the Affordable Care Act premium tax credits, which they want to qualify for. They're in the 0% cap gains bracket. They said muni bond income will still impact ACA, right? I'm not a tax expert. You should assume everything I say about taxes is wrong, but I believe that's correct. I think, in fact, I can, let's see here. This is from kff.org. They say here, because this is modified adjusted gross income is what counts, and you have to modify it by this. Adding non-taxable Social Security benefits you receive, any tax-exempt interest you earn, and some other things, foreign income. So yeah, I do think, at least based on that, and that triggers some kind of deep, dark memory in my slow brain that, yeah, that's not unusual for modified adjusted gross income. The tricky thing, by the way, is that you say, is that how you always define or calculate modified adjusted gross income? No. And then you might say, okay, well, where on my tax return will it show up? It doesn't. And after that, the IRS just says, have a nice day. Yeah, there's multiple ways to calculate it depending on why you're calculating it. And no, it doesn't show up on your tax return. Adjusted gross income does. Whew. Anyway, all right, back to the questions. Raj wants to know my thoughts on momentum ETFs. He mentions two, MTUM, VFMO. We'll pull up one of them in Morningstar. I think I've looked at MTUM before. Maybe not. I think I have. It's an iShares fund. Here it is. So the idea of momentum is that, you know, if stocks are going to go up, they're going to continue to go up, at least for a time. And if they're going down, you know, there's momentum, right? Things in motion tend to stay in motion, that kind of thing. I generally find these sorts of approaches to, I should back up. There is a lot of academic literature that supports the idea of momentum investing, that it is a factor. It is a factor that can, among others, there's other factors, right? Small cap is a factor, value is a factor, but momentum is one of them. And there's a lot of big believers in momentum. I generally look at it and think, I just don't know that I need to complicate my portfolio with yet another fund to try to tackle momentum. And so I just, you know, I think, how much am I going to be willing to put into this fund? It's a large cap growth fund. And how much is it going to really move the needle? The reality is, we could look at performance, but I guess you'd compare this to a large cap growth, right? Sometimes this will probably outperform, and sometimes it won't. Long term, it's probably a crapshoot. I don't know. If we look at the actual holdings, yeah, it's a lot of tech. Oh no, they're not completely. NVIDIA, but like you got Eli Lilly, JP Morgan, obviously not techs, but you got Amazon and Facebook. So that's actually a mix, which is kind of interesting. But I just find it kind of an unnecessary complication, and one that's not cheap. It's, I guess it is cheap, 15 basis points. I mean, it's not as cheap as like a total US stock market that you get for a couple of basis points, but that's fairly inexpensive, 15 basis points. So, and this is a popular fund. It's got over 10 billion in assets. So I'm not at all saying this is a bad fund or anything like that, but I just don't see the purpose in complicating the portfolio. I suppose you could do some analysis. Maybe we could, what I'm thinking is, does it affect the overall volatility of your portfolio in a positive way? Let's pull. So I'm looking at Portfolio Visualizer. As many of you know, they changed the whole look and feel of it. So it's like well, actually, they've done a couple of things. They've changed the look and feel of it, but they've also limited the data on a back-tested portfolio to 10 years unless you pay for a subscription, which I have not done. But we can, we'll just leave the total stock market fund here. Let's put in the momentum fund. We'll get rid of this, and let's put in QQQ as another growth fund, right? And so we'll do 100 for VTI, 100 for momentum, and 100 for QQQ. We're only going to get 10 years of data at most. Let's see what we get. So we do get the 10 years. Yeah, boy, it still takes me time to adjust to this. So QQQ is a large cap growth, but it's specifically tech, right? So over that time period, Portfolio 2 is the momentum fund. It's beat the total stock market, by about 80, maybe 90 basis points, with very similar standard deviation. So it's had good performance over the last decade. Of course, QQQ has trounced them both, but that's basically the Magnificent Seven. We all know how they've done over the last decade. So by no means a bad fund. How much am I going to put in it? And how much is it really going to move the needle? And do I need that complication? That's kind of how I think through it, for what it's worth. All right. A lot of thank yous for going back to the chat for questions. Yep, you guys are smarter than I am. Maury wants to know Roth conversion gotchas, importance of using non-Roth money to pay taxes. So here's the deal. Let's say we're going to convert, I'll just make up a number, $10,000 from traditional IRA over to a Roth. And it'll cost us, let's say, $2,500 in taxes. We've kind of got two options. I guess you could combine these two options as well. But one option would be, okay, you take the 10 grand out, you leave back 2,500 to pay the taxes, and you put 7,500 in the Roth. The other option would be put all 10 grand in the Roth and take $2,500, out of your savings account or checking account or wherever you've got it, and use that to pay the taxes. Well, of course, the difference is if you think about this step by step, one way to look at moving all 10 grand into the Roth and paying the tax from some other source is that you're effectively taking that money out of the checking account, so to speak, and putting it into a Roth IRA. At least when you compare it to paying the taxes out of the IRA money itself. I guess another way to put it that would not sound so convoluted is when you pay the taxes from a separate account, you end up with more money in the Roth, right? You end up with 10 grand instead of 7,500. Yes, you've taken $2,500 out of, say, a checking account to pay the taxes. You're gonna have to pay that one way or the other. The net result is, though, that if you compare the two, the difference is you've effectively taken the 25 out of, say, your checking account and moved it into a Roth as a practical matter. And here's the way I think about this. We know that with a Roth conversion, what we're hoping is that we're willing to pay the taxes when we do the conversion today because taxes will be cheaper, cost us less than if we didn't do the Roth conversion, and down the road, either because we took the money out to spend it in retirement or RMDs kicked in, whenever we took it out at some point in the future, we would have to pay more taxes than we would today if we did a conversion. So it's like, oh, I'll pay now. That's not great, but I'm going to pay less. So that's a good deal. And as you know, it's almost never an exact science, right? You're doing your best to do the right analysis, get the best answer you can, but there's just too many unknowns, and we can list probably at least 20 of them. But we don't know how taxes are going to change, how your income is going to change, your filing status might change. You may or may not decide to do qualified charitable distributions out of your IRA in place of an RMD. And there's a host of other possible things that could affect whether or not it's a good deal. But here's the thing to know. I believe this is correct. I think I did a video on this like 3 years ago. In that analysis, if you pay the taxes out of the IRA money, so you take 10 grand out, take 2,500 of it to pay Uncle Sam, put 7,500 into a Roth. You're sort of locked in. You've got your taxes that you paid now, and you've got the taxes you would have paid, we don't know when, right? But at some point in the future, had you not done the Roth conversion, right? At some point, you don't know what that might be, but it's out there somewhere. And whether it turns out to be a good deal or not, doesn't matter how long you leave the money in the Roth. You could leave the money in the Roth for 1,000 years. Doesn't matter. You could leave it in for a year. Doesn't matter. What's going to matter is the taxes you paid when you did the conversion and the taxes you would have paid had you not done the conversion. You get no benefit for leaving that, what is $7,500 in the Roth account for pick your time period. Now, some of you are probably saying, well, it's a Tuesday, so Rob's probably just off. Maybe it's a slow night for him. Maybe he's tired. I am kind of tired because you've heard that it matters how long the money stays in the Roth. That's true. It does matter if and only if you pay the taxes from some other account and you move all 10 grand into the Roth. Then you do get the benefit of keeping that money in the Roth for a longer period of time. In fact, you could even have a situation where the taxes actually might have been a tad lower if you'd not done the conversion and waited to whenever you were going to take the money out, let's say 20 years later. But because enough time had gone by and you got that benefit of that extra 2,500 in the Roth growing tax-free, it could actually still make the conversion turn it out to be, a good deal for you. And if it was already a good deal, it turned out that it was going to be a good deal, regardless of how long you left the money in there. Leaving it in there is going to make it an even better deal. Now, we're generally not talking about some huge difference, but it matters. So that's a very long, and I'm sure if I were to listen to that, my answer I just gave you back again, which I hope I never have to do, convoluted, but hopefully that makes sense. And I believe it to be true. So it's got that bonus. Dave wants to know how SIPC works. So SIPC, so we have FDIC insurance, right? That's for our bank account deposits. SIPC is for brokerage accounts. And the idea behind SIPC is if you've got money at a broker, and let's say the broker steals it, unbeknownst to you, the broker is taking money out of your account and moving it over to a hedge fund that the broker also controls and using that to invest in crypto. Now, does that sound familiar? That would be FTC, but they were in the Bahamas, so didn't apply. But let's say they were in the US and they basically steal your money. If, as a result of that, I don't know why a timer on my phone is going off or on my watch and I can't stop it. Anyway, if as a result of that, SIPC is insurance that could cover you. Now, with FDIC insurance, it's different, right? FDIC insurance covers you if the bank goes under, right? You say, well, okay, but what if the broker goes under? That in and of itself shouldn't affect your money. Let's assume the broker goes under, but there's no fraud. They didn't steal your money. And unlike a bank, broker might, I don't think they get liquidated. Actually, I don't know. I started to say, can a broker declare, I guess, did Lehman Brothers, they went bankrupt, right? Yeah, they went bankrupt. So yeah, they can go bankrupt. A bank, the FDIC insured banks, they don't go bankrupt, right? The government moves in and takes over. But the difference is that when you put money in a brokerage account, you control that money, right? You decide how it's going to be invested. Whether you want to buy shares of Apple, which I own, by the way, or Microsoft, which I don't own other than through an index fund, or a T-bill or whatever, you make that choice. And it's not, these are not assets that show up on a broker's balance sheet. It's not their money. It's your money, my money. So if they go bankrupt and the creditors come into a bankruptcy court and they say, hey, judge, we want all of Rob's money in his brokerage account to cover our debts that the broker hasn't paid, the judge would say, well, that's not the broker's assets. That's not part of the bankruptcy estate. You can't have it. And in fact, with Lehman Brothers, they went bankrupt. I don't think SIPC paid out a nickel. You guys can check me on that. I don't think they did because there was the money was still there. It didn't get stolen, and the creditors don't get access to it. They might get access to any assets that the broker owns, but not the brokerage accounts themselves, because those don't belong to the broker. They belong to you and me. With FDIC insurance, when you deposit money into a checking account or savings account, that shows up on the bank's balance sheet, and they could do with it whatever they want, subject to regulations, of course. Make car loans, home loans, business loans, personal loans. They're investing your money not as you want them to invest it, right? You can't call up the bank and say, hey, I just deposited $1,000 in the checking account. I want you to buy Apple stock with it, right? No, that's not how it works. The bank decides how they're going to invest that money because it belongs to them. Now, they've given you an IOU. They have to give you that money back if you ask for it. But if they go under and lose that money, sorry. And the one thing that saves us is FDIC insurance. I believe all that to be true, but I could be wrong. All right. Have I caught up with where I can show you some questions? I don't know. Let's see. No, not quite. Woods wants to know, in your opinion, I assume that's what IYO means. You got to remember, I'm of that age where you throw acronyms at me, I might not know what they mean. Are robo-advisors such as Vanguard and Fidelity an acceptable way to exercise dollar cost averaging? Absolutely, sure. Yep. I mean, there's no reason why you can't open up a robo-advisor account. Could be there, Betterment, Wealthfront, and contribute whatever, $100 a month, $500 a month, $1,000 a month, whatever you big spenders want to put in there. Absolutely. Yep. So another acronym, and I don't know what it means. And I kind of feel embarrassed that I don't know what it means. It's like I should know, but Carolina, I'll just put it this way. What's FP? I don't know. I'm guessing husband, wife, partner, person of importance. I know you guys are all laughing at me right now, and that's okay. That's what I like about doing this show. I can't hear you laughing. Is asking me to move my 401k to Fidelity, Vanguard, or whatever due to fees. My financial planner? Maybe that's what it means. I don't know. What is your favorite, whatever at the moment? I don't have anything out of my 401k. If I had to pick one, I would say Fidelity is my favorite. I would say Schwab is a close second. Vanguard is not my favorite right now, but I think if the situation you've got is fairly simple, you have an IRA, maybe a taxable account, I think Vanguard's fine. I will say one thing about Vanguard, and as I recall, this was one of the reasons I moved most of our stuff out of Vanguard. There were a lot of reasons, but this was sort of the last straw. You can't reach them on a weekend. Now, I don't know if that's changed, but you can reach someone at Schwab or Fidelity on the weekend. You can't reach someone at Vanguard, in my experience. Maybe that's changed. Okay, I think I've now caught up where I can now, show you the questions. Josh says, I started tracking our dividends and interest per your video. I did a video on sort of tracking your investments. And one of the things I said was, it might be good to track your dividends and interest. They're certainly more consistent than price. So anyway, any suggestions since the video on additions or things to watch for? No, I don't think so. Not that I can think of. I have been looking at tools that will track the dividends and interest for you and project what your income will be through the rest of the year, next year. I can tell you, most of the brokers that I've used don't do that. Schwab does. You can look at your future estimated income at Schwab. You can do it with Empower, but you got to know what you're doing. It's a little tricky. Let me see if I can show you. Let's see here. I don't know how I don't know if in my demo account I can show you this easily. While it's loading, I will tell you, you can also do it with Stock Rover, which is not a tool I've talked a lot about. I have an account, and it's like drinking from a fire hose. If you want data, Stock Rover's got it. Pardon me. M1 Finance is starting to do that. They've actually launched some new features, but you may not be using M1 Finance as your broker. All right, let's see if I can log in. Oh, I've got to, hang on, two-factor authentication. There we go. Whoops. Hang on, I'll be right back with you. That was wrong. Maybe. Okay. So this is a demo account. And if you go to banking, and cash flow, which I don't have any because I'm not linked accounts here, so I guess I'm not going to be able to show you. You can go into cash flow and say, look, I only want to see income from my investment accounts. Unfortunately, I can't show you. But the one thing I'll mention is to do that. Let me pull another screen up real quick. See if I can find this. There's a setting you have to change. Here it is. So if I'm not going to show you this because there's personal information, but if you go to settings, under profile and settings, you will see exclude investment income, dividends, and advisory fees from your cash flow and budgeting. There's a checkbox. And a lot of times it makes sense to exclude it if you want your budget and the cash flow to just show your regular income and expenses. But you can uncheck that and it'll show it to you. Sorry, I can't show you that. But it's there. You can do it. But other than that, Josh, I can't think of anything new. All right. Let's see. Let me look at the poll. 65% say yes. So only 7% said no. 28% don't care. That's fair. All right. Maybe we'll do another poll in a minute. I kind of want to get through more questions. Shadow Guy says, can't stay since it's 1 a.m. in Switzerland. Well, I mean, of all the lame excuses, just kidding. I know I couldn't stay up till 1 a.m. So this is a good question. Angela says, could what happened at Yotta, I don't know, happen at Raisin? You said you spoke to them. I did get a response to them, from them. I didn't fully understand it, if I'm being honest. So the issue with, is it Yotta? I guess it's Yotta. It's in yada, yada, yada. I don't know. Yotta, whatever. They were using a third-party company to send money from them over to the partner banks they were using. That company went bankrupt, but I haven't checked the status in the last several weeks, but there were a lot of issues. I don't know where it stands. I don't think it's been resolved. That's not how Raisin does it, is my understanding. And one of the things they use is another bank as an intermediary. Having said that, as I've thought about this issue myself, I think the more companies you put between you and your money, I suppose, the more potential for something to go wrong. And so and that's true, by the way, if you're at, say, a Vanguard and you're going to use one of their FDIC insured account, which is through partner banks, that you're putting, another company between you and your money. Now you could say, well, it's Vanguard. Yeah, I get it. I would, Raisin, I think, is a big company, but it's obviously not Vanguard, hasn't been around as long. Obviously, a lot of the financial apps, even smaller and whatnot. So I don't know of any reason to think that a Raisin is unsafe, or that, even for that matter, Vanguard is unsafe, or any of these fintech type arrangements where the app or company is using partner banks for the FDIC insurance, because there are some advantages to it, right? One is extended FDIC insurance coverage. In the case of Raisin, you can quickly switch from one bank to the next through one account, and they've improved that actually over the last month or so. But I think there's always a potential for something to go wrong. So at the moment, I don't have any of my money in those types of accounts. I'm not saying I wouldn't under the right set of circumstances, but I don't at the moment. Okay. I had Mike Piper on the show, actually. He was my last interview, I think, about open Social Security. But those are two, I want to make some notes. Those are, I could have Mike Piper on for Roth conversions. All right. I'll have to look at all of these after the show. Kitz's, I've had Kitz's on before, so if you haven't seen that, you might want to watch that video. I've interviewed Wade Pfau, but I don't think I've interviewed him on this show. I interviewed him years ago, so he's another good one. Yeah. All right. I appreciate all those recommendations. I will go back. Actually, yeah, this is another one. Stan the Annuity Man. I need more annuity content. So that's a good one. If anyone knows Chairman Jerome Powell or Warren Buffett, let me know. I'll see if I can get him on the show. I don't think that's going to happen. A neighbor was an economist that worked for Bernanke at the Fed. Doesn't help us today. All right. Remember, if you want me to cover a question, just put at my name, at Rob Berger. That helps me find them. Okay. Nurse Jake, any other apps, I guess, is beside, like New Retirement, that's free? Probably Empower would be the one that comes to mind that's free. It's not as robust as New Retirement or some of the others. I mean, but I think it's a good retirement planner, given that it's free. But I don't think you can. I don't think there's a lot you can't do with it, or but it can certainly give you a sort of a bird's eye view of retirement readiness. There are certain calculators that might be free, but I just don't. They're generally fairly simplistic, so I'm not aware of other free options. But I'll keep an eye out for that. Okay. Yeah, I get this comment a lot about New Retirement or other tools I talk about are only useful in the U.S. And I get some questions from folks in Canada, and I just don't have, I don't know of apps that are useful outside the U.S. Okay. Mike, these are very good suggestions. If you don't know what RISA means, by the way, just Google it. Basically, Wade Pfau's idea, and I think this is a really good. I like the work he's done in this area, because there's folks like me who say, I'm not really interested in annuities. I've got my investments. I'll do some kind of safe withdrawal, and I'm comfortable with that. And there are others that say, Rob, that would scare me to death. I need a lot more comfort. I like the warmth and security of a guarantee. And what Wade Pfau says is, there's not a right or a wrong here. A lot of it comes down to a person's personality and maybe their financial situation to some extent. And there are some people that are going to want to do it the way I've done it. He calls that a sort of a probability approach, because it's all probabilities, because we don't know how the market's going to turn out and inflation and everything else, versus a guaranteed approach. Of course, it's not always one or the other. You can do a combination, right? I could take some of my money and buy an immediate or deferred annuity, right? I would never buy like an indexed annuity or anything like that. But I think he's spot on that. I think he's absolutely right. There's a lot of different ways to reach the same goal. And when you're 100% probability based, maybe you have some Social Security, but that's it in terms of guaranteed income, you tend to underspend, because that's kind of what you have to do to make sure you don't run out of money. And a lot of studies have been done, that people have written about this idea that if you annuitize some of your portfolio, the nice thing about an annuity is, you get your check every month. You got no problem spending it all, because you're going to get another check the next month, just like Social Security or pension. I think that's a valid point. Now, it hasn't caused me to go buy an annuity. I haven't ruled it out. You never know. I'm still somewhat young for an annuity, I think. You may disagree. Once again, it's good that I can't hear you. Oh, okay. I see all these other suggestions. Appreciate it. I will go back and look at them. All right. I actually was just interviewed for a podcast. I don't know when it's going to come out, but I'll share it in the newsletter when it does. That was earlier today. Okay. Okay. Rob 2 wants to know, do we need to be more concerned about RMDs than IRMAA? Well, I think we need to be concerned about both. Concerned might be the wrong word. We need to prepare for both. The thing about IRMAA is not everyone needs to worry about IRMAA, because depending on your income situation and of course your age, you may either be well under the IRMAA numbers or well over. You may be in a situation where it doesn't really matter what you do. You're going to pay extra on premiums for Medicare. It's only going to be those people that are sort of right there, in that range where it can matter, and it's sort of a cliff. If you go over it, you pay the extra premium. But if that's you, you should be concerned with it enough to figure out where you stand, and if there's anything you can do to avoid it. On RMDs, this is what I like with a program like New Retirement, but other software does this too. You can get an estimate of what your RMDs will be and what your taxes will be on those RMDs. Again, it's an estimate, because the RMDs are going to depend on your account balances. Well, we can only estimate that. And of course, tax laws could change and everything else. The RMD age has changed multiple times. It's going to change again. 8 years from now, 9 years, going up to 75. And it could change even more, right? I mean, Congress can do what they want there. So, but I think you need to be prepared for it. And that's where Roth conversions, among other things, because the thing a Roth conversion does, among other things, it lowers, of course, your traditional balance, which in turn will lower your RMD once you hit that age. So they're both important. I think they're both important. Yeah. So Hybrid Cap says that Rob Berger is growing his hair out. So thank you. He said, looks good. All right. I actually went to get it cut today. I go right down the street from where we live. I go in, a guy used to work in the military cutting hair. Man, he's quick. Done. And he wasn't working today. And I didn't want to have someone else cut my hair. So I'm going to try again tomorrow. All right. I'm seeing more interview suggestions. I appreciate that. Matt, if you're watching, or when you do watch, maybe you can just do a spreadsheet of all of the interview suggestions for me. That would be great. All right. Yeah, Dave mentions a question based on the election. How will it affect the impact of sunsetting of the Tax Cuts and Jobs Act? I mean, it's a great question. But, you know, part of it's going to depend on Congress, right? That's a big part of the whole equation. So Dave says we have a 6-3 SCOTUS, Supreme Court of the United States, that post Chevron, it's a decision they put out not long ago, will have a big impact on economy, regulations, etc. The deal there is, and I dealt with this in my practice because, so I worked in most of the time in a DC law firm. And although I didn't do this kind of work, the firm did a lot of work in the energy field, nuclear, FERC, the NRC, a lot of employment law, a lot of some lobbying work. But we would often have cases that involve government regulations, right? So, because what happens is the legislature passes a law, and then it's up to the executive branch, right, which includes all the agencies and so forth, to effectively implement those laws. And they do that through enormous amounts of regulations. And I'm not, you know, it's unreal. And some folks will from time to time challenge those regulations. They may say, "Oh no, you've got it all wrong, whatever agency or department. You've interpreted the statute that Congress passed, the president signed, in a way it's wrong. You got it wrong." And when they would take that issue to court, the court would say, "Well, it's kind of like in baseball. The tie goes to the runner. Yeah, if as long as what the executive branch, this government entity, as long as their interpretation is sort of reasonable, we're gonna let it pass." And the Chevron court said, "Yeah, that," and I haven't read the opinion, so I'm just going on what I've read about it in the press. "Yeah, that's not going to work anymore." Right? I will read the opinion because it is of interest to me, even though I don't practice law anymore. But I suspect it's in part a separation of powers issue. But the point of it is going to be, it will be easier to challenge regulations in court now. Now, you know, is that a good thing? Is that a bad thing? I don't know. I always ask, will it help the Ohio State football team win a championship? I don't think so. I don't think it'll help or hurt. So how important can it be? All right. It is actually important, but there you go. All right. You know, you guys have behaved yourselves pretty well, even though we talked a little politics today. I'm very proud of you guys. Oh, and Noreen's got my back. Rob Berger is not a tax expert. Please consult with your tax professional for advice on your particular situation. That is so true. That is so true. Okay. So Fast Eddie has a question, and you should remember, this is a tax question. So remember what Noreen just told you. I'm not a tax expert. This reminds me of those word problems in grade school in math. You know, 2 trains leave. Let's try it. The 5-year Roth rules. If I put 5,000 in a Roth, and that same year I convert 5,000 from an old IRA to a Roth, and I'm 55 years old, okay? When I turn 59 and a half, can I take the money out tax-free, no penalty? Wow. Well, let me do my best to answer this, and you should just assume I'm wrong. This does reminds me of math in like the 5th grade. I loved math, my favorite subject, even though I was an English major. Should have been a math major. Anyway, so the first thing you did was you put $5,000 into a Roth. So you made a $5,000 contribution. What we don't know in your word problem is, was that your first ever? I'm going to assume it was. I'm going to assume you've never had a Roth IRA. You opened it up at 55, and you contributed 5,000. So first of all, that money, those contributions, $5,000, can always be taken out at any time and for any reason, penalty and tax-free, right? Because it's a contribution, not a conversion. You contributed, you've already paid taxes on it, right? Now, that's the first thing. I believe that to be true. The second thing, let's say you did this today. From a tax perspective, they assume you did it on January 1 because it's tax year. You did it on January 1, okay? So in terms of the 5-year rule that applies to the Roth accounts themselves, you got to have a Roth account open for 5 years. If you're 55 today, now I don't know if you're 55 now. Are you going to turn 56 this year, or did you turn 55 earlier this year? Because it's going to matter, because you got to count 24, 25, 26, 27, 28. That'll be your 5th year. But again, that's not going to apply to the $5,000 contribution, right? Because you can take that out penalty and tax-free anytime. But it would apply to your attempt to take any earnings from that $5,000 out. You got to meet that 5-year rule. You've had a Roth open for 5 years. Again, maybe you didn't include it in the word problem, but maybe maybe you've already got a few bucks in a Roth that you opened up years ago. You've already met that first 5-year rule. Okay. So far, I believe everything I've said is true, I think. Anyway, the conversion is different, right? That gets evaluated on its own. And each conversion gets evaluated separately. And my understanding is that, and there is a separate 5-year rule on conversions. Remember, you've already paid your taxes because you did that when you converted. But the question is, will you get hit with the 10% penalty? And you've got to wait 5 years or turn 59 and a half. That first 5-year rule we were talking about, where you've got to have any Roth account open for 5 years, 59 and a half won't help you. If you're 60 and you open up a Roth for the first time, you got to wait 5 years for that rule. Again, that doesn't affect taking out contributions, though. I know it's confusing. You can always take out the contributions, but the earnings on those contributions, you'd have to wait 5 years or you get in trouble. 59 and a half won't save you. And there's some logic to that. That 5-year rule is saying, look, we want people to treat Roth accounts as saving for retirement. What does that mean to the IRS? You have Roth accounts open at least 5 years. And you say, well, but does each separate Roth IRA have to be open 5 years? No, just one of them. And you say, well, does that make any sense? Well, it kind of does if you remember that the IRS treats all of your Roth IRA accounts as one. Doesn't matter if you've got one at Vanguard, Fidelity, Schwab. They treat it all as one. With the conversion, the issue is, are you trying to get around the 10% penalty? If you just pulled money out of your traditional IRA at 55, assuming no exceptions apply, you of course pay taxes, but you'd also get hit with a 10% penalty. What they wanted to avoid was people saying, well, okay, I'll convert to a Roth, got to pay my taxes, but I have to pay those anyway. Now that it's in a Roth, I can pull the money out without the 10% penalty, right? And the IRS said, yeah, not so fast, because we're going to call this a conversion contribution. It's a special thing, and we're going to hit you with that 10% penalty unless you keep it there for 5 years. But once you turn 59 and a half, you would have been fine under the traditional IRA, right? You wouldn't have been hit with that 10% penalty. So they're not going to hit you with it again. So the 59 and a half year mark can save you from having to pay the 10% penalty on a conversion. I believe that to be true. Whew, I'm exhausted. All right. I hope that's all correct. I think it is. But as always, consult your tax professional. And by the way, read the chat, because I guarantee you there are CFPs and tax experts and estate lawyers and rocket engineers watching, and they will absolutely put in the chat whether I got it right or not. Okay. Here we go. Is it a good time to move capital from a large cap stock to the Russell 2000 before the elections, especially if the Fed reduces the interest rate? I think, so the short answer to your question is, I have no earthly idea. A more extended answer would say, look, figure out an investment plan and stick to it. So if we look at the Russell 2000, let me see what I can pull up. It's smaller companies, by the way, if you're wondering, like, I wonder if there's an ETF. Well, I know there is. Let me just see if I can find one to pull up. I don't know tickers on this. Oh, Vanguard has one. Oh, the VTWO, of course, VTWO. Here it is. We can go to the portfolio, and you'll see companies. Some you'll know, some you won't probably. Yeah, most of these I don't know, because they're smaller companies. If you look at the average market cap, you can see it's quite small. So there was actually a Wall Street Journal article about, are things changing now? Are we moving out of the Magnificent Seven and the large cap and the growth, changing into a different kind of situation where small caps are going to take off? The short answer is I have no idea. I would add to that, nobody else knows either. There are plenty of people guessing, and some of them will guess correctly, and then you'll find them on CNBC or whatever, or Jim Cramer will have them on, and it'll sound like they're geniuses. But I have no earthly idea. What I prefer to do is just to have an investment plan and stick to it. Sometimes small cap will do better. Sometimes large cap will do better. I'm covered with all. I've got a little bit of everything. You get that in a total stock market fund. I do have a little bit of extra in a small cap fund. I think it's impossible to know. If I had to guess, I would say, well, the Fed's probably going to lower interest rates. That could help growth, right? But there's so many different factors. This really is an important point. You have to decide what kind of investor you are. And I think it's hard to do nothing for a lot of people. And it took me a while to really wrap my mind around that. It's hard to just sit there when all of these crazy things go on in our world, in our markets, in our economy, in our politics. And what I found was, if I just have a low-cost, diversified portfolio, which by definition is going to have parts of that portfolio will not be doing well all the time. There's never a time when I don't have some part of my portfolio that just stinks. Now, depending on how I'm holding it, I might not notice as much. So if you have a total US stock market fund and mid-cap value is just tanking, you're probably not going to probably notice that unless you're really, really paying attention. But that's just diversification. And there are YouTube channels that take the opposite view of what I've just described to you, and they're always telling you the hot new thing, and they can get a lot of views and a lot of subscribers because there's a lot of people that buy into that, and they're on the edge of their seat, waiting for the next thing that the Fed's going to do, or what some bank is going to do of some country. I don't think I could be successful that way. I've got enough experience to know I'd screw it up. All right. Kyle, I don't know that. So this is an interesting question. Any thoughts on weighing the long-term tax drag from a tax inefficient fund against the one-time cost of realizing capital gains to move out of it? What's VDEQX? Let's look that up. I don't know that one. Or I don't know the ticker. Oh, Vanguard Diversified Equity. So this must be a actively managed fund, 35 basis points, which is, by the way, cheap for a actively managed fund. A lot of Vanguard's active funds are in that range. So let's look at a couple of things. I just want to see, oh, it's a fund of funds. Okay. So it owns other Vanguard funds. We can look at its distributions. If we go to performance, by the way, what I'm showing you here in Morningstar is all free. You can see over here, I'm not signed in. This is not a paid account. You can look at all of this stuff yourself. Anyway, go to performance, then go to distributions. By the way, these numbers in and of themselves are not helpful. You need to compare the amount of long-term capital gains and short-term gains and whatnot to the market price. So in 23, it distributed what, 150, 160, about $2, 40 cents in dividends, 26 in short-term cap gains, and 138 in long-term. So we'll call it $2 on a $44 NAV. So, well, we'll call it 5% distribution. Yeah, a little less maybe, thereabouts. So not the worst thing in the world, but I guess 22 was kind of rough. I'm guessing that was because of the market was, of course, a mess in 22. Surprised they didn't have some more losses, but to offset. But that had to be because I'm sure they didn't do well in 22. What was their performance in 22? Yeah, they lost 22%. Plus, you had a big distribution. Anyway, you know, I don't know of any tools that can help do that. They might be out there. I'm not aware of any. And I'm not even sure exactly how I would do the math on that. Of course, part of it would be what your tax bill is going to be if you sell. Of course, you don't have to sell it all at one time. You can do it over time. Obviously, if you had losses to offset some of the gains, that would help. But I'm going to assume from your question you don't. So I don't know is my short answer. I mean, I think I could puzzle it out if I had that specific set of circumstances. I was confronted with it and I could try to just do some math. But I certainly couldn't sit here and do it in my head or think through. It would definitely involve a spreadsheet. It's a good question. I wish I could be more helpful. Let me see. So Peter says, I have a pension and Social Security that covers most of our needs. Is it worth saving in tax-advantaged accounts? Well, if you've maxed out retirement accounts, tax-advantaged accounts, sorry. Well, my question to you would be, what are you saving for? And the answer might be, well, nothing specific. I'm just generally saving. And since I've got enough for retirement, should I put the money in, I guess, a taxable account as opposed to a tax-advantaged account? But, remember, you don't have to use a tax-advantaged account for retirement, right? And if you don't, if whatever you're saving for, you decide you're not going to need that money until you're in retirement, why not take advantage of the tax-advantaged options? And even if you needed some of it before retirement, if you're using a Roth, you can always take out your contributions, penalty and tax-free. I think the only reason maybe to stay away from that is if you were going to use the money at a time when you'd get hit with penalties if you took it out of a tax advantaged account. Plus, if we're talking about a 401k and there's an employer match, that's a whole nother ballgame, right? I think. So Mike points out yet another factor to consider on Roth conversions, and that is if you think the Roth funds will be inherited. In other words, you won't spend them, but you'll leave them to loved ones. And that's absolutely true, and there's some studies on this. But what you need to then factor in, it's not just your tax rates during your lifetime, but the tax rates of the people that might inherit the Roth. I find that to be theoretically accurate, but as a practical matter can get a little tricky. One of the reasons it gets tricky, I think, is because we by and large don't know when we're going to die. There are some exceptions, and so, let's say you're my age or older, but you think, maybe I've got 10 years, 20 years, whatever. And then you're starting to think, okay, well, let's say my children or whoever you're going to leave the money to, what will their tax situation be in 10 or 20 years? I don't know. They don't know. Or maybe they do. Maybe maybe they're teachers and you can their income is predictable. Somewhat predictable. Yeah, as a practical matter, I think it can get tricky. But at the end of the day, with Roth conversions generally, we're often just making our best educated guess. And by the way, software won't help. Software will help you, but it won't solve the problem for you. You're still making an educated guess, even if you use software. Software just helps you crunch the numbers, but we're still making an educated guess. Rob wants to know updates on hiring a financial advisor. So I'm in the middle of using one, and it's been slower than I hoped. Partly that's my fault. And I think I'm going to try a second one. I'm going to spend money on a second one. So I have two to share with you and compare. They're both flat fee. I'm spending money. So again, got to give me like a month probably is my guess. All right. O'Brien Tracy wants to know, what type of funds do you keep in your Roth accounts? What would you recommend for a retiree Roth that is being invested for their kids? So for possibly 20 more years. So I keep stock funds in my Roth. I want my Roth to grow as much as possible because it's tax-free if you follow all the rules. At the moment, I have SCHD, which is a Schwab dividend fund. I don't have it because of the dividends per se. It's more because it's a value fund. It's not a recommendation. I think it's a good fund, but there are plenty of others, and that's what I have in all of our Roth and HSA accounts. If I were investing for a young person, I might use the same fund. I might just go with like a VT, which is a Vanguard fund that invests throughout the world. If someone said to me, you've got to make the investment, and you can't change it for 50 years, I would invest in VT. Of course, you can always change it. So maybe that's a pointless question, but that's what I would invest in if I couldn't change it for 50 years. It's a good question. What would you guys invest in if you couldn't make a change to that investment for 50 years? Luke wants to know about the best thing money can buy is financial freedom merch. I'm afraid, Luke, that I think it was the last show, I asked about merch, and I got shot down. No one wants the merch. Now, it was Burgerhead merch. I don't know how much of that influenced the poll. Maybe I need to do another poll. But here's the problem with merch. It would require me to do something to like make it happen. I'm definitely, so I found this interesting. This is something I've been thinking about. So I've been retired. Well, I retired from law in 2016. But I think when I left Forbes, which was 2020, I felt retired after that. I mean, I have a YouTube channel, makes money, but I do whatever I want. And I found that my attitude towards retirement has changed over those 4 years. I was more uptight early on. I'm very laid back now with how much time I put into the YouTube channel. I'll say income producing things. I do things that I enjoy. If I don't enjoy it, I'm not going to do it. And that's become even more pronounced. So I don't know about merch. I'm probably leaving good money on the table. So Kat wants to know my thoughts on value and small cap value. I'm generally view myself as a value investor if I'm going to pick an individual stock, although I own Apple, it's not a value stock. When I bought it, it probably was. Or when I bought most of it, because I bought it in 2013 initially, after it slumped significantly because of a bad quarter. And then I bought some more at the end of 2018, 2019, when all stocks had fallen. But yeah, anyway, I kind of generally, if I'm going to buy individual stocks, I lean towards the value side. And my small cap today is mainly a blend fund. But before that, I had a lot of small cap value, a lot, 10%. Mainly just because historically it had done quite well. Today, my small cap is just, like I said, it's a blend of value and growth. I will say I feel the more I don't know, the older I get and the more I've invested, the less I feel compelled to try to tilt my portfolio in some way that for some reason I think will position it for higher returns. Only because there's really no way to know that. There's just really no way, in my view. It's not to say I've got a perfect, it's not like I have everything in total U.S. stock or market, but that's kind of generally where I am. Billy wants to know my thoughts on Yieldmax funds. I don't see the purpose. They make no sense to me. We can pull them up. So let me see if I can pull up an example. So here is a list. I don't know what happens when I click on this. Maybe I'll just take this off the screen for a second, click on it and see what. Okay. So these are single stock ETFs. This one invests in Tesla, and then I think it sells covered calls. Oh, it doesn't. It does not. It does not. The fund does not invest directly in Tesla. Investing in the fund. Let's see. What's it buy? I thought it owned stock and then sold calls. It's an option income strategy, actively managed fund that seeks to generate blah, blah, blah. Man, someone needs to talk to the marketing department. All right, hang on. Now I'm aggravated. Really? That's like the best you got? That's terrible. Yeah, it's a covered call ETF. How can they not invest in Tesla? Are they naked call? That can't be. Hang on. I want to figure this out. I was just looking at these funds the other day. Maybe it doesn't buy calls. It's a covered call ETF. Oh, here we go. Structurally, it's not like a traditional covered call ETF, whereas most of these funds own the underlying security. This is what I'm reading from. Make it bigger. The Yieldmax ETFs creates a synthetic. That's a fancy word. Long position to replicate the movements of the underlying stock using option contracts. They then write another call option on Tesla. Okay, fine. I don't see the point of doing this. I don't see the point of this at all. I don't know if maybe someone in the chat can say why doing that, investing that way would make sense. To me, this is a good example of Wall Street coming up with a product that absolutely nobody needs so a company can make money. You can quote me on that. It's got an expense ratio over 1%. It's ridiculous. Its 12-month yield is 81%. That's funny. In 2023, investment price, 50%. Yeah, this will not go well. No, I think I would not invest in a Yieldmax fund. All right. Matt wants to know, at some point, is there a point where you should reduce retirement savings, in a tax-advantaged account and contribute in a taxable brokerage account instead if you're going to retire before 59 and a half? Well, you could, but there are ways to get your money out from a retirement account before you're 59 and a half without paying penalties. It depends if it's a 401k with your current employer. There's the age 55 rule, which you can Google. You can take equal payments. There's ways to calculate that, and there's rules around it, but substantially equal payments. You can do sort of strategic Roth conversions, sort of 5-year ladders, so that each year a certain amount, satisfies the 5-year Roth conversion rule that we talked about. So I would at least explore those options before making a decision, because there are tax advantages, of course, to contributing to retirement accounts. And if it's a 401k, I certainly would not be giving up the employer match if you have that. But it is true, if you're going to retire before 59 and a half, you do have to have a plan in place. But there's plenty of ways to do that. And I would explore those first before making a decision. Apparently, when I was having trouble with the acronyms, What's Up posted that. I know the last 4. Rolling on the floor. Huh? I got it. I just feel so young now. All right. If my son is definitely not watching. If my daughter's watching, she's laughing right now, I can assure you. Oh, here we go. As of last weekend, you could not reach Vanguard on a weekend. Really? Yeah, so I guess it hasn't changed. Kat wants to know, when I moved assets from Vanguard, I transferred in kind. And you have to make sure you can do that. The ETFs shouldn't be a problem. Most mutual funds shouldn't either, but depending on the funds, there could be an issue with that. And then if you do move the mutual funds, when you go to sell them, they could charge you a fee. You could, depending on the fund, you might be able to convert it to an ETF at Vanguard without tax consequences and then move it in kind. That's another possibility to consider. Adrian likes the chess content. Yeah, we got to do a couple puzzles. I did not play well. I won 1, lost 1, and drew 6. The problem is that the one I lost, I shouldn't have lost. I should have drawn it. And probably 5, well, certainly 4 of the 6 I drew, I should have won. I just didn't play well. I did not play well. All right. Oh, but I did, so in Philly, I'm walking around and someone stopped me. Hey, Rob Berger, I watch your show. So I got chatted with him. And then I was in New York. Someone stopped me on the street in Manhattan to watch the show. And then yesterday I ran into Terry and his wife, Lisa. I don't know if Lisa watches the show. I think Terry does. I may have that wrong. Ran into someone that watches the show in an Apple store. It's always fun. Rob wants to know, is it always recommended to convert your 401k to an IRA when you retire? No. I mean, in fact, that age 55 rule where you can get some of your money out without the penalty, that only applies if you keep your 401k with your last employer there. You roll it into an IRA, the age 55 rule doesn't work. You may like the investments that you have, and there might not be any reason to take it out. IRA may give you some more flexibility. Depends. In theory, well, I guess if it's a rollover IRA, but you might get more protections from creditors, which may or may not be a factor for you in a 401k. So yeah, I wouldn't say it's always recommended. So Angela, I think I did get back to the Raisin question. I think. All right. Yeah, Vinyl talks about, so Synapse is the company that was between Yotta, and their partner banks. But not all fintechs are structured that way. So you just have to dig into their agreements and understand, how they work. I think I ran into Vinyl. I think I saw Vinyl posting a message on a Reddit channel involving, I forget what it was now, but money. I was going to say hi and then I didn't. I don't remember why. Probably got distracted with the chess game. Jason didn't mention me in his question, so maybe he meant this for someone else, but I'm going to answer it anyway. Thoughts on FSKAX? I know that fund, but I don't remember what it is. Oh, it's just total market. So I think this is a perfectly fine fund in a taxable account. I basically have the same fund, although I have the Vanguard version. But one thing you can look at is if you go to performance, we looked at this a minute ago, and you go to distributions. So what I'm looking at here, I don't want to see any blue, because blue is, depending on the shade, short-term and long-term capital gains. You're going to have income, right? Because total market fund has dividends. Doesn't have a lot, but it has dividends, which is what they mean in this case when they say income, right? So we go to VTI, which is Vanguard's total stock market fund. They have a mutual fund version too, but we're looking at the ETF. Yeah. And by the way, these bars look higher. It's irrelevant. You gotta always compare it to the NAV. You can't compare this bar to Fidelity's bar and say, oh, this bar is higher. It's meaningless. You got to compare the amount. Like, so for 23, it was $3.41. In fact, let's here, Here, let's do some quick math. I'm pulling up a calculator. You know we mean bits. So 341 divided by the NAV at the end of 23 was 236.09. We'll just say 236. Yeah, 1.44%, which is basically the yield on the total market, right? If we go back to the Fidelity Fund and we go to distributions and we do the same thing for 23, I'm going to guess it's right around 1.4. So 186 divided by, what was their NAV at the end of December? 132. Yeah, 1.4. So, there'll be slight differences here and there, but yeah, you got to compare this to the NAV. Hope that makes sense. Favorite chess piece. I don't have a favorite chess piece. Do chess players have a favorite? I don't know. Maybe they do. You can tell, though, when you're playing someone, particularly in speed chess, you can see playing styles very quickly. So you'll see some people that bring out their queen early, and they, under no set of circumstances, do they ever want to exchange their queen. It's their favorite piece. You can tell. So you start using your queen to chase their queen around the board, trying to offer to exchange it. They don't want no part of it. It's kind of funny. Okay. Jeremy says, would you be able to, at some point, some content on how to go about structuring your side income for tax efficiency? At what point to register it as an LLC? Best way to track related income expenses? I could. I'm not going to remember this guy's name. I can picture him clear as day. Maybe I've subscribed to his YouTube channel. Let me just quickly see if I can find it. He's great about that. He's funny too. Some of you guys will know this person, I think. I'm looking at all the channels I subscribe to. Oh, here he is, Mark Kohler. Yeah, this guy. I think he's a CPA. Oh, he's a CPA, a JD. Check out his channel. He's a lot of fun. He's a lot of fun to watch. I haven't watched one of his videos in a while, but he goes through how to structure a business. Could be a side business, and I generally, I think, from what I know, I'm not a CPA, but I think he's right. I will say that when you think about tax efficiency, an LLC in and of itself, at least as far as I know, there might be some ways, but it's not so much a tax efficiency issue per se, as it is a limiting your personal liability, right? So that's certainly one thing to think about, whether you form an LLC. In terms of the best way to track related income and expenses, I mean, I can tell you what I do. One, I have a business bank account. So all income goes into that bank account. I get a few things through PayPal, which drives me nuts, but literally 99.7% of my income hits one business bank account. And then I have three business credit cards, and all of my expenses, 99 point whatever percent, hit one of those three business credit cards. So, and all of those are connected to QuickBooks. I have a bookkeeper, so they do all my bookkeeping, send me financial statements once a month, and then connect with my tax accountant at the end of the year to make sure she has everything she needs. It's very easy. I used to do it myself, and then a couple of years ago, I don't remember when. Anyway, I hired a bookkeeper, and it's very easy. So, but yeah, check out Mark's channel. He's fun to watch. I need to check out some of his more recent videos. I haven't watched him in a while. How are we doing? Is it 8:29? Man, time just flies. I got to put up a chess problem quick. I had a good run today. If I go to my archive. I lost a few here, but I went through, I had a lot of, the pluses are wins. I had one game. Let's see, was this? That was a fun game. I was going to show you one of these. Well, this was, I'll just show you this game. I'm bragging a little bit, I guess. I can show you a loss too if you want to see them. The reason I liked this game, and then I'll put up a puzzle. By the way, if you guys are, for those that are new to the channel, this is what I do at the end of the live show. So I'm white. I always play e4, pawn to king 4. And this person played what's called the Caro Con, which is c6, this pawn move. And all of this I played within probably 10 seconds, all of these moves, I would say. Because they're all what are called book moves. These are sort of, this is known opening theory. And black played queen to b6, which is actually a mistake. And it's not like losing the game, but that is not really a great move. And you'll see why. So I can take, so now he's got to deal with it, right? Because I'm attacking the queen. But you say, well, no problem. He just takes with the bishop. Which again, this is not losing for black by any means, but I start to get some moves in that force black to move pieces again, while at the same time allowing me to develop. So I'm attacking the bishop, so he's got to move it back. And then, boom, I now can develop my bishop and at the same time attack black's queen. So now black's got to deal with that. He can't let me take his queen. So he moves back. And here it looks like black can win this pawn, right? Because you got the queen and the knight on it. I'm only protecting it with the knight. It turns out that's not true. So I can actually push the knight. Now, black played knight to a5, which is the better move. Because the problem with this move is this. And now I'm going to win this pawn and the rook. Because the queen obviously can't go here. I'd take it. So, yeah, probably here. And then this is what would normally transpire. Something like this. And this is actually, this bishop is strong. I've got some problems on my queen side. This is not like a one game for white, but it's a nice position. Anyway, black didn't do that. Black played here. And so in this is all book for me. Like, again, I've not spent, I don't know, does it show me my time? It doesn't, but I have not spent much time at this point. I guess it shows you time per move over here. Anyway, this is all, I'm pinning the knight, attacking it. And here he kind of bailed, which actually is probably the best move under the circumstances. Actually, yeah, the computer says this is the best move, even though it loses the queen. And then here, it's a tough position. That's really bad because this, and then he did that, and that was a mistake, and now he's going to lose the rook. Anyway, it's a fun game. I liked it because for me, it was all book to about here. What move is that? 15. I guess that's not that many. All right, enough of that. Puzzles. There you go. All right, I'll look at some last minute questions. While you guys give me the answer to that puzzle. Eric says, just simplified his portfolio. He's got an S&P 500 and a total bond. Boy, that's actually very close to Warren Buffett's preferred portfolio. He would use T-bills instead of total bond. And I think he would have a 90-10, but that's, Warren Buffett. Very good. All right, what else do we have? So Chris wants to know if I plan to get a long-term care policy. I don't. I mean, the reality is with policies available today, you're going to get maybe, these ones I've seen, total coverage of maybe in the 300,000 range. And I've just decided I can just self-insure. So I don't have plans to get a long-term care policy. That is another person I'd like to interview, though, someone who's got LTC experience. I quickly went to the bottom of the chat to see if anyone had helped me with this chess puzzle. And no, not a single person. So I guess I'm left to my own devices. Let me see if can I do this? How about that? There we go. So what I want to do is this, right? Because that's a beautiful, you got two rooks like that, you boom, and they're going to lose a rook. The problem, of course, is black can check with one rook. I've got to move my, wait a minute. What am I doing here? I'm white, right? I'm losing my mind. It's black to move, and white has just moved. Okay, forget that. I'm thinking it's white's turn to move. So I can check him here. He goes here. I can check here with the other rook, and he goes here. So what I want to do is take this square away from white. So why can't I just go here? If he takes, I take back. It's still stuck. He can't. Can he advance this pawn? No, it's still. That's interesting. He could push that pawn. By the way, on this move, I'm not worried about this, right? Because I'll have a check. But after exchange, assuming he exchanges, he can push this pawn. What do I do about that? I guess I could just take. Because he can't go to this square. He could go to this square, though. I don't know. Let me see if you guys help me. G4. So you're all thinking the same thing I am, G4. I don't know what's going to happen. Well, I'll go here. I'm pretty sure I take. Well, that's easy enough. So I don't even get to the problem, which happens sometimes. So let's say he does this. Rook B2. Oh, that's funny. The whole time I'm thinking white's going this way. It's going that way. Well, I got it right. You guys got it right. We'll try one more. Maybe I can have my head examined. All right. All right. I think that's a good topic, Angela. So I got to just find someone. Gary, I'm curious what, like how to calculate your estimated quarterly taxes. I'm not sure how much help I could be on that. I'll have to think about that. A lot of comments on the LLC. Vinyl agreed, liability, yes, but not on taxes. I don't know how Fidelity would invest our money on its own account. We can certainly, you can have an arrangement with a broker in a separately managed account where you authorize it to invest your money on your behalf. And that's fairly common. I have friends that do that. I don't, but okay. Vinyl says to Nick, I'm an hour behind on comments. I'll never get to you. That's it. We're getting to Nick. What do you think of VCIT? See, Nick, we're getting to you. I got to take the puzzle off though, because I don't know. I don't know what VCIT is. All right, can you guys remember the puzzle? And then I'm going to have to go. It's 8:40. My wife's probably wondering where I am. Vanguard Intermediate Term Corporate Bond Fund. Okay. I mean, this is, I think this is a good fund. It's cheap, 4 basis points. It's going to invest in, it's got a duration of 6, which is similar to the total bond fund. But unlike the total bond fund, this does not invest in government bonds or secured assets. It's all corporate bonds, but they're all investment grade. As you can see here, BBB and up. So it should have a slightly better return, I would think, but probably maybe a little more volatility. But that's you could compare it. We could go to a chart and let's compare this to BND. And let's look at the last 5 years. Yeah, they're pretty close. Of course, they're negative because of 22 was bad, but it looks like actually it outperformed BND a little bit. I don't know what. Oh, this is 2020. Yeah, the one thing to look at, like you look at this here, and you might think, okay, but that's just a blip. But if you live through it, that's a pretty significant difference. So that's something to keep in mind. And if we go to max, do we hit 08? I don't know how old these funds are. No. It's interesting. It's outperformed over that period. If we look at risk, it has a standard deviation of 9. And I'm pretty sure BND is going to be lower than that. 7.3. Not a huge difference, but it's not as volatile. So there you go. I think it's a decent fund. I don't own it, the corporate bond fund. I mean, keep in mind the total bond fund includes corporate bonds, right? If you go to the portfolio. So there you go. All right, let's figure this puzzle out, and then I'm going to call it a night. Anyone give an answer? We've got Queen A4 check and Queen H7. So we're white and we're going up. So what are the choices you guys have given me? Queen A4. We're white. So yeah, Queen A4 would be check. And what's the other one? Queen E4? Queen H7. Oh, that's check too. Well, Queen A4, black can take the rook, right? That may not matter. Well, wait a minute. I can't play Queen A4, right? Because this queen, boom, would take me. So that's a problem. If I play here, he can't take the rook. He can't go here. He can't go here or here or here. He's got to go. Wait a minute. They've got these puzzles where you look at it and you think, wait, which direction are the pieces going? Isn't that checkmate? I mean, he can interpose the rook, but I take it. He can interpose the queen, but I take it. He can't interpose the pawns because the pawns are going down, not up. Am I missing anything? I guess not. There you go. Whew. All right, gang. Had a lot of fun. Hope you did too. I will be back, Lord willing, and the creek don't rise 2 weeks from yesterday. And I am going to do a new retirement, working session, whatever you want to call it, that same week. I don't know the date yet. It'll be in the evening is my plan. I'll announce that, on the live show, but also in the newsletter. So check that out if that helps. And hope you have a great week. Till next time, remember, the best thing money can buy is financial.